CFO. The Axis Bank results. There are too many results today, so let's just get into the results. Our operating performance in the quarter has been strong. We saw strengthening of NIM, controlled OPEX. We saw healthy business growth, reasonably steady asset quality metrics, and a decline in stressed corporate loan pool. We have continued to focus on what is in our control, strengthening our balance sheet and improving provision coverage. Overall, we remain firmly on track as far as our strategy is concerned, as evidenced by almost all the operating metrics. Having said all that, we recognize that we do need to improve in a couple of areas. The bank slippage numbers have remained elevated this quarter, reflecting the situation in corporate lending I spoke about earlier. Almost all of our corporate slippages came from previously disclosed BB and below rated clients. We have a residual stock of stress built up over the years. While slippages continue to come from this stock, the current macro environment is not enabling a quick rundown of the pool. To that extent, we expect slippages from this stock to remain elevated. The good news is there are some examples where slippages from this book are likely to be recovered in the next quarter. In our business segments, we are seeing some signs of positive momentum returning in consumer segments. In car loans and home loans, the number of credit applications are increasing on a sequential month-to-month basis. Structurally, we continue to see huge opportunities in Indian retail banking. Consumer debt levels have gone up marginally in recent years, but remain significantly below developing country averages in almost every product category. Axis Bank's market share in these businesses has increased significantly in recent years, but is still not very large. So the opportunity and the desire on our part to grow this business remains very strong. Our focus on the retail customer has also led to sustained growth in our granular deposit franchise through our CASA plus RTD strategy. The bank had strong deposit growth during the quarter at 22%. Despite this strong deposit growth, CASA is another area we need to do better. We need to improve our CASA growth going forward, and our teams are working hard towards that goal. During the quarter, we opened 190 branches, our highest in the last 24 quarters, to take the bank's overall domestic branch network to 4,284 branches. Branch banking continues to be an integral part of our growth strategy. Despite these investments in extending physical branch network, we have been able to keep OPEX growth under control at 6% year on year. In the small business and MSME segment, there are some signs of stress in terms of delayed payments. We need to remain cautious as the funding issues in NBFCs could have a bearing on this segment too. The bank's risk performance in this segment remains steady, but we are watching things closely for any adverse development. Given some of these conditions, the bank is also being cautious about the growth opportunity in the SME segment right now. Our subsidiaries continue to deliver strong operational performance in a very challenging environment that for NBFCs, Axis Finance continues to thrive and has delivered strong returns with stable asset quality. Axis AMC has been gaining strong incremental market share with several of its funds among the top performing ones in their respective categories. Axis Capital continues to be a leader in equity capital markets, having executed some of the market transactions during the quarter. During the quarter, the bank also raised 12,500 crores of capital through a QIP issue. We understand that this was the largest ever QIP by a private sector issuer. Successful closure of capital raising in a current tough market conditions is a strong indicator of investors' willingness to partner with Axis Bank in the bank's long-term growth journey. Axis Bank is now in a position of great strength with capital and most of the senior management team's addition in place. With most of the asset quality issues behind us and strong competitive position in the current environment, we remain committed to delivering on our GPS strategy. We continue to invest in our conservative stance on provisioning, compliance and risk. We have a lot more to do on improving and automating our systems, controls and processes. It's a gradual process. It will take time, but we are working at it and improving every day. With that, let me hand over to Jairam to take you through the bank's financial performance in detail.
Thank you, Amitabh. As he said, I'll also try and keep it brief. A quick rundown on some of the numbers. profit before taxes for the bank for the quarter stood at 2,433 crores, up 109% year on year. There was a one-time tax impact of 2,138 crores due to change in corporate tax regime. X of this extraordinary item, profit after taxes would have been 2,026 crores, but including this, it was a net loss of 112 crores for the quarter. Operating profits for the quarter were up 45% year on year. Net interest margin was at 3.51%, the highest in the last 9 quarters. Our cost to assets ratio continues to improve at 2.06%. It was the lowest it has been in the last 12 quarters. Provision coverage ratio continued to increase for the 6th consecutive quarter and is now at 79%. We also hold 2,600 crores of additional provisions over and beyond what we count in our PCR calculations. Gross NPA and net NPA ratios also fell for the 6th consecutive quarter. We are now at a net NPA ratio of 1.99%. In terms of slippages, of all the corporate slippages that we saw, 97% came from previously disclosed BB and below rated clients through their loan and investment exposures. Overall BB and below funded exposures reduced from 7,467 crores last quarter to 6,291 crores, so a decline of 16% quarter on quarter. Loan book grew by 24,000 crores in the quarter, our highest growth in the last 8 quarters in absolute terms. Deposits grew by 23% year on year in an environment in which market deposits are growing by less than 10% year on year. So the bank has done really well on overall deposits. As Amitabh said, we have added 190 branches, the highest we have added in the last 24 quarters. And finally, with the capital raise that the bank did recently, the bank's common equity tier 1 ratio was at the end of the quarter 14.04%, the highest ever common equity tier 1 for Axis Bank. So those were some of the metrics. You have seen some of the data and information in detail. We are open to your questions now. No, we continue to be conservative in terms of provisioning on NPAs as well as the stress pool, whether it is the BB pool or the SMA pool, etc. So we decided early this year to start providing for them on a formulaic basis consistently. That's what we continue to do. There is nothing special going on.
But is there any trigger in terms of more stress in the SME or the retail book?
No.
So just a question, your total slippages was 4,983 crores, of which 2,862 came from corporate. So if I assume 2,100 come from the retail and SME book, you just said that you're cautious about the SME lending. Is this due to larger macroeconomic challenges, or what are you seeing in your SME book, or at least
So let Jairam talk about the specific numbers, and I'll be.
Yeah, I think if you look at the overall split, 2,800 crores of gross slippages from wholesale, 1,300 from retail, and about 760 odd from SME on a gross basis. But on a net basis, if you see IE X of all the recoveries that we got very strong recoveries in retail during the quarter. So net additions in retail or to NPA were only 500 crores and 450 odd crores in SME. These numbers are not large in absolute terms. We are okay with it. That said, it is true that given some of the stress that is going on in the larger corporates, where some of them are not getting payments on time, they in turn are not paying some of their SMEs on time, and that's creating a little bit of stress in the system. So overall, we have gotten a little bit cautious as cash flows are getting a bit stressed and stretched, I should say, not stressed. So we are looking at where the market goes before we get a little bit more aggressive. You see that in our growth rate numbers as well, where we have slowed down growth in commercial.
Let me just add, if you don't mind. If you look at our overall stock of stress assets, you will see that overall, firstly, our stock has come down. Secondly, you also have to recognize, and we said that last time also, that some of the assets in our stock of BB and below has been there for a long period of time. And in a deteriorating economic environment, we have seen some of this stock kind of go into slippages. So we have said that yes, some of our slippages will continue to remain at elevated level if the economic conditions do not improve. We obviously continue to, it's not that whatever goes into slippage is not recovered, we do recover. Adding on the SME side, yes, as Jaram very rightly pointed out, that we have to be cautious given what we are seeing. The payments are getting delayed. Some of the sectors are impacted in a big way, and I think the sector which gets squeezed the first is MSME in the SME sector, so we have to be cautious around that. As far as our retail book is concerned, we are not seeing any signs of any stress in any kind of portfolio of ours at this point in time. But we have been saying it again and again repeatedly that we have to remain cautious, we have to watch the book, we have to ensure that we take corrective actions as and when we see any signs of deterioration. But right now, nothing as yet. Sorry.
I was saying merely that because you flagged out these risks in SME, obviously the NBFCs, etc., would you not look to add these to your double B and below rated book to sort of guide the investors accurately about the kind of stress that you see?
Yeah.
Or
Sorry.
do you think it's something that may not be considered?
See, the SME book, the total SME book that we have is close to 60,000 crores. The split of that by rating we offer every quarter to the investor community, and you will see that about 10% of that, or just under, has been under below what we call SME 5. That is the indication that we have always been offering in terms of what's going on in the SME segment. The double B portfolio we've kept for large corporates, and we think that's where ratings make a lot more sense, and they are a lot more stable and predictable. And you will continue to see us offer that as the core area of guidance in terms of where stress is coming from. As I mentioned before, of the 2,700 crores of net NPA formation that we saw in this quarter, only 450 came from SME. So it's small enough that I don't want to nuance it too much in terms of trying to predict that too precisely.
So you keep SME out. What about NBFCs, other financial companies where there is stress? Would those not be added to double B?
Whatever is stressed is already in the double
In
B.
the double B.
Yes, there are some NBFC names in the double B book. Yes.
So almost 10% or so of your book is to financials. How much of that do you think is potentially likely to see some stress?
Whatever we worry about in the short to medium term, we have put it in our double B portfolio. So the total double B portfolio is reflective of that. I don't want to get into specific names here, but I'll just stop at saying that there are some financial sector names that are part of that pool as well.
Just to ask you, how do you see the resolution for any NBFC, regardless of the names that are currently in the market, those ongoing litigation proceedings? Tomorrow there'll be another bunch of NBFCs or HFCs that could go because there's no sort of legal framework to deal with this.
I mean, so you've answered the question in your question itself. Yes, it is obviously very, very complicated. In many cases, a lot of mutual funds have actually gone to the courts to prevent any payouts whatsoever. I think government is looking at it quite closely. You are hearing of reports again being reported by people like you that government is trying to come up with a resolution mechanism. There are many regulators involved. There are very different interests involved in terms of how this needs to be resolved. So I think government obviously needs to apply its mind, and including the regulators, and ensure that whatever framework they come up with does work. As you can make out, some of the assets which have, or some of the companies which have gone into stress have been in that category for the longest period of time, and you still don't see any resolution in sight, which is not good in the long term for the sector itself. But let's see, let's wait and watch, because I think it's quite obvious that the government is working on it.
No change in your, what you always quote as the credit cost guidance with the long-term average that you have. Is that something that you expect to be?
No, there is no change. We are not. We are sticking to whatever we have promised as part of our GPS 22 strategy. Yes, we're not changing it, at least at this point in time.
The loan book also grew at the fastest pace from last week's quarter, as you mentioned. But considering that there are challenges in the economy right now, and you said that you're going to be cautious in growth, what do we see those?
I'll ask Rajiv to comment on the wholesale side, and maybe Pralay to comment on the retail side.
I think it is a challenging environment, but having said that, it's ultimately like an equity investor, we are lending to companies and not the economy, and so therefore in each sector we are able to find opportunities to be able to lend based on that company's long-term cash flows at a price that we are quite comfortable with. And so therefore we are seeing growth on the corporate side across the spectrum in terms of sectors as well. So there's no lumpiness in that sense either.
So if I can add on the retail side, I think we have enough opportunity and avenues to grow. To give you a specific example, while auto loans, generally the car segment has slowed down, but we have seen reasonable growth in our portfolio. And the reason for that is our core franchise, which is the liability franchise, is expanding, it's getting larger, and we are doing data analytics to actually offer customers, our own customers, the products at a risk-adjusted returns what we want. In addition to that, what we're doing is, as Amitabh already said, that we are adding branches, and also we are doing specific things on the deeper geography so that we expand our markets into deeper geography, because that's where also expansion will happen for us, a lot more than what has happened in the past. So when you look at the whole spectrum, and we have all the products and services, given that our quality of the portfolio is extremely good, and actually the newer acquisition is getting better, we will continue to grow this portfolio profitably. So I don't see any kind of slowdown in our portfolio at this stage.
What is the 1,300 crore slippages from retail coming from, sir, broadly, for this quarter?
Sorry, I'm having some mic challenges. I'll try and speak up. Thank you.
Yeah, worked, Jaram.
All right. 1,300 crores of slippages in retail. That cuts across retail lending, credit cards, and the agriculture business. Agriculture has been seeing some challenges for a little while. This quarter was better, so we're not seeing as much of it come in this time. The core retail lending businesses, whether it is the secured or unsecured side, are seeing NPA formation in proportion to their share in our retail lending book. So there is nothing noteworthy there in terms of particular segments in which there is stress. There is, of course, a little bit of stress emerging in the commercial vehicle space. Our portfolio in commercial vehicles is not that large, so we're not seeing as much of an impact of that.
You spoke in the earlier part of the conference, you said that most of the asset quality issues are behind you, and then you said that you expect the slippages to remain at elevated levels. Don't you think that the industry community and the shareholder community will actually be confused with the guidance? Because
No, there is
in that sense, it seems to be two different things.
No, it's not two different things. The reason I'm saying is that I think we have some of the new stuff which we've been doing, those kind of asset quality issues are behind us, but there is a stock. And we have to ensure that the stock either moves up or goes down, maybe remains where it is. But the aging of that stock is increasing over a period of time. So yes, we have enough capital. We are seeing a certain economic environment where we're seeing things go down rather than go up. But we have dimensioned that particular stock. That stock, as we have saying very clearly, is actually going down over a period of time. So on that basis, our asset quality issues, once they're dimensioned, are behind us, is what I meant. Thanks for asking.
So those 2,600 crores of excess provisioning that you made is largely for recognized stress?
It's double B and stress book.
Yes.
Yeah.
Any comments on your partnership with Max? Again, because I think there's a tie with Bajaj in your partnership.
See, we have had a long and very fruitful relationship with Max over the years. We continue to be happy with that partnership. As and when there is something to talk to you all about in that regard, we will come back to you. As of now, there's nothing to talk about.
So just coming back to loan growth again, is there any guidance that you have?
We have said in the past that our loan book will grow 5 to 7% faster than market. In this quarter, as you saw, the market's been growing at about 9%. Our domestic book has grown 19%. So we have done a little bit better than what our short-term expectations were. We continue to hold our expectations in terms of 5 to 7% faster than market.
Sir, do you think insurance and deposits will increase to 5 lakh as widely discussed?
Well, I think, again, we have read reports about the fact that there is a committee which has been formed which will look at various options, and one of the options being talked about is the increasing the amount of insurance which will be provided to the depositors. Let's wait and see as to when the committee comes out with the report and what RBI decides. It is obvious that the amount, maybe 1 lakh, has been there for a long period of time. It does need to be looked at. So we'll wait for the report to come and RBI to decide.
So should there be a separate term for institutional depositors as well?
It will be wrong on our part to start speculating. So let's wait for the report to come.
In terms of tax changes at the bank level, how have you dealt with it, and at the subsidiary levels, because there will be different levels there? Any broad?
No, we've made the same choices across the entire group. We have all chosen to move to the new tax rate and give up whatever little deductions we might have been seeking in different parts of the bank.
Any recovery target for the full financial year?
We do have internal targets, but we have not made them public. I'll just say that recovery so far this year has been on par with what we saw last year. So, which is of course much higher than what we have seen in years past. So it's been a decent year for recoveries, but it's not accelerating as one had as one might have hoped. So as the IBC process continues to push through, and there have been a lot of conversations about some of the really large cases that are in IBC. So they need to move through for recovery numbers to really get more traction.
So which is this tax expense, the tax expense which is basically hurting your overall profits?
Yeah.
What is that provision, sir?
So deferred tax assets at the bank stood at 7,700 crores at the end of the first quarter, and 7,600 crores broadly at the end of the last financial year. That deferred tax assets line item was aggregated assuming a tax rate of 35% in years prior. Now that the tax rate has become lower, you've got to write it down to the lower rate. That delta is about 2,138 crores, which is what we have taken as a one-time hit through P&L in this quarter's results.
You have been increasing your provision coverage ratio, as you said you want to be conservative. So now it is at 79%. Is that it, or will you look to take it up further?
I think we are broadly there. We don't give very specific guidance on this, but let me say that we are broadly there. It's not going to go too much higher than here. All right. Thank you very much, everybody.
Thank you.
Thanks for your time.
So people, when they invest and the calls go right, they're